Hey everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Each week, I'm going to break down the complexities of what's happening in real estate, mortgage rates, and the economy, and I'm going to deliver it to you in a way just how you consume it best. So if you're somebody who doesn't really care how the clock's built and you just want to know what time it is, I'm going to give you the highlights in about a minute or so, and then you can go on about your day. Now then, for my friends that like to know how the clock works, and for my clock builders out there, I'm going to go ahead and slow it down, and I'll explain why rates are moving, what matters most, and how to really think about this cycle. So let's start with the short version. The labor market, it continues to cool, even if the headlines aren't screaming it yet. The December jobs report, it showed 50,000 jobs were added, but that missed expectations. But the bigger news on that was the revisions. October and November, they actually got revised downward by 76,000 jobs. And if you think about it, most of December's job gains, they came from healthcare and holiday-driven leisure and hospitality. So if you were to strip those out, well, job growth is negative again. Now, private payrolls rebounded in December. They added 41,000 jobs, but that was still a miss based on forecasts. And over the last 5 months, private employers, they've added just about 27,000 jobs in total. Now, housing starts fell below their lowest level since the pandemic, and permits actually slipped as well, meaning that supply relief is probably going to be a little bit slow. And as of this afternoon, bonds were slightly weaker, but there wasn't any major catalyst that was driving today's movement. Volume was pretty light, which is pretty typical for a data-free Monday, and the 10-year Treasury auction was actually pretty well received. Now, mortgage bonds are still range-finding after last week's really strong rally, and so the translation for all this is that today just really didn't matter much, but tomorrow does. So here's where rates finished using Mortgage News Daily's national average. The 30-year fixed rate was 6.01, FHA 30-year fixed was 5.7, and the VA 30-year fixed rate was 5.71. Now, we're very carefully floating into tomorrow's CPI report. So if you're closing within the next couple weeks, this isn't a set it and forget it moment. It's more of a real conversation with your lender moment. All right, now let's go ahead and talk about how the clock actually works. Now, this is where a lot of people get tripped up because they look at one day in the market or one data set and they assume that it tells the entire story, and it never does. Markets don't move on quiet Mondays. They move on data that changes expectations. Now, today was low volume, low conviction trading, and there was not really a clear link between the overnight headlines and bond movement. And mortgage-backed securities, they just underperformed because they're still kind of digesting last week's big move. And that's normal. The labor market, meanwhile, it actually continues to soften in stages, not all at once. First, job growth slows. Then that turns into revisions to move prior month's numbers lower. Does that sound familiar? Then hiring slows, and then you see quit rates fall. And then continuing claims stay elevated. And that's exactly what we're seeing right now. This isn't a booming economy, but it's also not a collapsing one either. It's a cooling, lower momentum environment, which is exactly why inflation data matters so much right now. And that brings us to tomorrow. Now, tomorrow's CPI, it's actually expected to be a much more tradable, reliable release than the last one, which was actually impacted by data collection issues around the shutdown and reopening timeline. That's important because when data quality improves, market reactions get sharper as well. And for a quick refresher, everybody, CPI is the Consumer Price Index, and it measures what consumers pay. It's kind of backward looking, and it's basically a gauge of what the public feels. Now, PPI is the Producer Price Index, and it measures what producers pay. Now, it often leads CPI, and it acts as kind of an early warning system. Mortgage rates don't move on today's inflation. They move on what inflation is expected to do next. So when CPI prints tomorrow morning at 8:30 a.m. Eastern, markets are going to immediately ask a handful of questions. Is inflation still sticky? Is it slowly bleeding off? And does this change how long rates need to stay restrictive? Now, if CPI comes in soft or flat, especially in core services and housing components, bonds can break higher and rates are probably going to improve. Now, if CPI surprises higher, even modestly, bonds will probably sell off pretty quickly, and that's why tomorrow morning's trading deserves far more attention than anything that we saw today. Now, this is not a moment for emotion, it's the moment for patience, positioning, and discipline. Now, we'll be watching the CPI release and the bond market reaction really closely tomorrow morning. So make sure and check in with the Shoemaker Loan Team on Facebook tomorrow afternoon for some real time updates and lock float guidance on the market as it digests all this data. And really soon, I'll be releasing my 2026 mortgage and housing market forecast. It's focused on probabilities, risks, and planning, not hype. So, hey, everybody, thanks so much for spending a few minutes with me today, and I can't wait to see you again next week.